It's September 21st. We're going to look at the market and the price action with the technical analysis and see which direction it's going. What we have here is the Dow Jones from September 2009 until right now, September 2010. And what we have here, after a long run up in the market of a nice reversal from the recession, we have the head and shoulders pattern. The head and shoulders pattern is supposed to look like head and shoulders. We got a shoulder here, head, and a shoulder. If you draw a line connecting the two shoulders, they're basically at the same level. If you draw a parallel line to the top of the shoulders, you have a baseline or a neckline right here. And what a head and shoulders does is it follows a nice run up in the price in the market, and it's usually a reversal pattern. So you have a shoulder, head, shoulder. The question is, with the head and shoulders, does the price jump out the top, or does the price over here, does it drop through the bottom? Usually the head and shoulders is a reversal pattern, so the price is usually pops out the bottom over here. And the danger of this pattern right here is that we could go back into a recession if this does not hold up. So this is our market right now. The question is, does it go above and cancel this head and shoulders, or do we drop back below and return to a recession? If you look at this is the S&P from 2008, September 2008 till now. This is a bigger picture of the head and shoulders. Again, you have the shoulder, the head, and the shoulder. And you see the price action is bouncing off the shoulder level. You got 1, 2, 3, almost 3 shoulders here. And also you see that the head over here is finding a lot of resistance at this red line. This red line is the 200-day moving average, which is an average of the past 200 days, or in this case weeks, because this is the weekly chart. And if the price, the way the moving average works is if the price comes up from below, it's expected to bounce off. So right here, it bounced off, and it's expected to go down. It might struggle against it again right around here at the 1200. And if the moving average is below it, if you look at this 100-day moving average, the blue one, if it comes from above, it usually bounces off and goes back up. Right here, 1 and 2. So again, head and shoulders, and not only is this a reversal pattern where we could go down, but we have the resistance at the moving average, which could pose some trouble again. Even more dangerous than that, the smaller head and shoulders that we have right now is a bigger head and shoulders pattern. This is the Dow Jones from 1971 to now. And again, sorry about that, it says head and shoulder over here. It should be shoulder, head, shoulder. It looks like another head and shoulders pattern is forming, but this one is huge. This one's from 1997 till now. So this was a technology bubble right here. This is the housing bubble, and this is where we are now, which could pose a huge drop. You see the top over here is 14,000, the bottom's around 7,000. If the price is expected to bounce off this top line, which is where we are now, and it could drop back down. If it breaks below this neckline, we could be seeing Dow 1000 or Dow 4000, somewhere around here. Very dangerous. Now, the reason why I bring up the head and shoulders pattern is I'm going to compare it to the Great Depression, which is not too comforting of a thought. But what we have here is the Dow Jones Industrial from 1904 to 1930. What you see here is we have a sideways trend where the price does bounce around, but it doesn't really exit the top or the bottom line here. So it just goes sideways for about 17 years. The market kind of stalled. After this, it broke out from the top line, and it shot up from about 100 on the Dow to 380. That's 380% or 280% growth in about 7 years. And right here up top is the top and the peak before the Great Depression. So again, we have a sideways trend for a long time, 17 years, and then a run up for about 7 years. Now compare that to this chart. Once again, this is the Dow from 1960 to now. From 1960 to 1983 around, again, 23 years sideways trend of not too much price, even though it is relative price movement at around 500 points. It still stays within this trend, this trading range. All of a sudden, 1983, it pops out of the range, and from 1983 to 2007, it shoots up. Rapid growth for about 16 years. It goes from 1,000 to 14,000. This is an even bigger price increase than before the Great Depression. It multiplies itself by 13 times, 1,300% price appreciation. And again, this is the head and shoulders pattern that's forming. But if you compare these two, again, you got a sideways trend and then run up before the Great Depression, and again, the sideways trend run up before the Great Recession, which is what we're in right now. So comparing the two, this looks pretty familiar, pretty similar. Again, this is the Dow Jones from 1928 to 1930. What you have here, right here, is the peak of the Great Depression, or the top before the Great Depression. So the pattern that's forming here is you see a short sideways trend, kind of goes sideways for a little while, then it shoots up for the last gasp, forms this little top over here, and then from the top it drops all the way back to the Great Depression bottom, or not to the Great Depression bottom actually, but to a bottom in 1929. It shoots up again to 300, forms this, and then drops back down. So again, it's a sideways trend, up, down, up. Now compare that to the Dow Jones 2003 to now. Again, you have a sideways trend, shoots up to the ultimate top at 14,000, shoots back down to 6,500 in the recession that we just had, shoots back up here, and sets this up. Compare the two again. Sideways, up, down, up, sideways again, sideways, up, down, sideways. So they look very similar. Now, the reason I showed you that is we have a head and shoulders pattern that's forming now and also formed in the Great Depression. Now, this is what could happen if all goes well right here. What we have, this is the Dow Jones 1973 to 1975. In 1975, in that period in the Dow, we also had a huge drop, recession right here. Then we bounced back up, formed a head and shoulders pattern. So in our market, we're also in the same pattern. We had a nice recession, we dropped back up, formed the head and shoulders. Now the question we have now in our market is, where does this head and shoulders go? Like our market, they also had the 200-day moving average, and it also formed resistance at the top of the head. You see how price kind of is resisting to go up above the red line. Now what usually happens with the head and shoulders is you form the parallel lines connecting the shoulders, and the question is, which way does the price leave the pattern? If the price drops back through the bottom, it's expected to drop back down into recession. If it bounces off the bottom and goes back up, then the head and shoulders is considered a failed head and shoulders. What happened in 1975 is price moved all the way down to the bottom, but it bounced back up, and it's considered a failed head and shoulders over here. This is zooming in to the 1975 head and shoulders pattern. Again, we have a shoulder, a head, and a shoulder. We have the two lines, the top line and the neckline. Price moved all the way down to the pattern, but failed to break through it, so it's called a failure. And what happens from there? Price bounced back up and exited through the top. So this is a failed head and shoulders. Now, if we zoom out even further, this is the Dow from 1970 to 1990. What you have here is our head and shoulders that we just looked at is this tiny little thing right here. We had the top in the market right here. We had a recession just like we have in our market, just like we did. Then we bounced back up and formed the head and shoulders. So our market looks exactly like this. It basically topped out, it drops back down into recession, drops back up, forms the head and shoulders. Now, In our market, we're still asking whether it's going to go down or up, but in their market in 1975, it bounced off the bottom, it failed the head and shoulders, and it made its way back up. So from this failed head and shoulders, if you look, you got at around 800 was where the head and shoulders was. From there, that started a long run up to where we are today. The price of the Dow Jones never went back to this level at 800 again. And from there, it went to 14,000. So the failure in the head and shoulders helped bring us into a nice long bull market of over 20 years. Now, if we compare the same thing to the Great Depression, what we have here is the end of 1929 till, this is actually 1929. Again, you have a head and shoulders pattern. You have the neckline down here. Just like in our market and the 1975 market, you have the 200-day moving average, which is the red line. And you have resistance. Once again, the head fails, the price fails to push out over this 200-day moving average, and it bounced back down. The difference between this head and shoulders pattern and the 1975 shoulders pattern is over here, the price actually broke through the neckline to the bottom. So this is, once you see this, you have to sell, because this means just a huge drop from here. But what you see is a head and shoulders pattern, and it confirms the head and shoulders pattern over here. Again, this is our market to compare the two. What we have is the March 2009 bottom. We bounced back from the recession. We have resistance again at 200-day moving average, just like in 1975, just like it at in 1929. You got the shoulder, head, shoulder, and the question is, do we break through this neckline right here, or do we go back up? Again, this is the S&P, same situation. This is our time right now. Resistance at the 200-day. Now compare these two. You got the this is the right before the Great Depression, and this is us. All three look very similar. Now this is what happened from that head and shoulders break. So we had the run up. This is the Dow Jones 1928 to 1932. We had the run up to the ultimate peak at 380 on the Dow. Then we had a nice recession, just like we have in our market. Then it bounced back up from recession and formed a head and shoulders pattern right here that we zoomed in on before. Then we broke through the neckline. Like we saw, it confirmed the head and shoulders. And this is the signal to get out right here. But for those who didn't get out, the market went from about 260, dropped all the way down in the Great Depression to a low of about 46. So this was the head and shoulders, and this is what happened. This is the Great Depression right here. Now, the question in our market is the same thing. We reached the top of 14,000. We dropped back down into recession. We bounced back up, and we formed the head and shoulders. Now, again, question. Do we drop below, or do we go above? Above would be 1975, beginning of a nice bull market. Below would mean a nice, maybe even depression, could be just as bad as the Great Depression.